The SPY, our beloved S&P 500 tracker, took a nasty tumble right out of the gate on February 12, 2025. It was a shocking start to the trading day, catching many investors off guard. The opening bell had barely rung when the ETF began its steep descent, setting the tone for what would be a tumultuous session. Investors were greeted with a sea of red as the ETF opened below the psychologically significant 599 level. This drop below a key support level sent shockwaves through the market, triggering a wave of sell orders and amplifying the downward momentum. Fears over rising interest rates and lingering inflation worries sparked a wave of early selling. The market was already on edge, and this sudden drop only heightened those fears. Traders were quick to react, offloading positions in a bid to avoid further losses. Big tech stocks, usually a market darling, felt the brunt of the selling pressure. Companies like Apple, Amazon, and Google saw their stock prices plummet. Traders were clearly nervous, and the usual safe havens were not immune to the panic. No one wants to be on the wrong side of a market correction. The fear of missing out on gains quickly turned into the fear of incurring significant losses. Financial advisors were inundated with calls from anxious clients, all seeking guidance in these uncertain times. This wasn't some ordinary dip. This was fear. This was uncertainty. The kind of uncertainty that makes even the most seasoned investors second-guess their strategies. The market was sending a clear message, and it was one of caution. This was the market trying to tell us something. The mixed signals and erratic movements were a cry for attention, a warning that all was not well. Analysts were scrambling to make sense of the chaos, offering varied interpretations of what might come next. Were we headed for a full-blown correction? The debate was on. Some believed this was just the beginning of a more significant downturn, while others hoped it was a temporary setback. The uncertainty was palpable, and everyone had an opinion. Or was this just a temporary blip on the radar? Could the market recover quickly, or were we in for a prolonged period of volatility? The questions were many, and the answers were few. Only time would tell. One thing was for sure: it was going to be a wild ride. Investors braced themselves for what lay ahead, knowing that the market's unpredictable nature could bring both opportunities and challenges. The roller coaster had just begun, and everyone was holding on tight. Just when you thought it was time to head for the hills, the bulls came charging back. Around midday, the SPY staged a remarkable recovery, surging past the 603 level. The Relative Strength Index, a key momentum indicator, rebounded from oversold territory, signaling a potential shift in sentiment. Bargain hunters swooped in, scooping up shares of oversold tech giants. This was a classic case of buy the dip. Investors saw an opportunity to buy high-quality companies at a discount. The fear that dominated the morning session began to dissipate. Confidence was slowly returning to the market. But was it enough to sustain a rally? The SPY's midday rally lost steam as quickly as it started. After peaking around 605.85, the ETF succumbed to selling pressure, pulling back towards the flat line. The momentum simply wasn't there to sustain the upward move. Traders, unsure of the market's direction, took profits off the table. This indecision was a telltale sign. The market hadn't made up its mind. Were we in a bull market or a bear market? The answer, my friends, was unclear. One thing was for sure: volatility was here to stay. Section 4. RSI Roller Coaster, Navigating the Volatility. The Relative Strength Index, or RSI, our trusty momentum gauge, mirrored the SPY's roller coaster ride. This indicator, which measures the speed and change of price movements, is a favorite among traders for its simplicity and effectiveness. It oscillates between 0 and 100, providing clear signals about overbought and oversold conditions. The RSI's plunge below 30 in the morning session signaled an oversold condition, often a precursor to a bounce. When the RSI dips below this critical level, it suggests that the asset is undervalued and may be due for a reversal. Traders often look for these signals to time their entries and exits. And bounce it did, with the RSI surging back above 50 as the SPY rallied. This rebound was a clear indication that the market was regaining strength. The move above 50 is often seen as a shift from bearish to bullish momentum, giving traders confidence to ride the upward trend. However, the RSI's failure to break above 70, coupled with the afternoon pullback, painted a picture of waning bullish momentum. This level, often considered overbought, can act as a resistance point. When the RSI struggles to surpass 70, it can signal that the rally is losing steam and a correction might be on the horizon. This is why you gotta love the RSI. It provides a straightforward way to gauge market sentiment and potential turning points. Its ability to highlight overbought and oversold conditions makes it an invaluable tool for traders. It's like a crystal ball, giving you a glimpse into the market's soul. By interpreting the RSI, traders can anticipate market movements and make more informed decisions. It's almost like having a sneak peek into the future. But remember, even the RSI isn't perfect. It's essential to use it in conjunction with other indicators and analysis methods. Over-reliance on a single tool can lead to misinterpretations and costly mistakes. It's just one tool in your trading arsenal. Combining the RSI with other technical indicators such as moving averages or volume analysis can provide a more comprehensive view of the market. Use it wisely, my friends. The key to successful trading is not just knowing how to use the tools at your disposal, but also understanding their limitations and integrating them into a broader strategy. Section 5, Morning Strategies, Cautious Plays for a Shaky Open. Navigating a volatile market requires nerves of steel and a flexible game plan. In the morning, with the SPY gapping down and the RSI in oversold territory, caution was the name of the game. Short-term traders might have considered selling put options on the SPY, betting on a potential rebound. However, with fear running rampant, it was crucial to manage risk and avoid getting caught in a further downdraft. Remember, greed kills. Don't be a hero. Protect your capital. Section 6, Midday Tactics, Capitalizing on the Rebound. As the SPY found its footing and the RSI climbed back above 50, opportunities emerged for traders to ride the bullish wave. Buying call options or even establishing long positions in the SPY could have been profitable strategies. However, it was important to be selective and focus on stocks or ETFs showing relative strength. The key was to capitalize on the rebound while managing risk in case the momentum fizzled out. This is where discipline comes in. Don't get greedy. Take your profits and live to trade another day. Section 7, Afternoon Approaches, Protecting Profits, Seeking Opportunities. The afternoon session called for a more defensive approach. As the day progresses, market dynamics often shift, requiring traders to adapt their strategies. This is a crucial time to reassess positions and make necessary adjustments to safeguard gains. With the SPY struggling to maintain its upward momentum and the RSI failing to break above 70, protecting profits became paramount. Traders need to be vigilant, watching for signs of weakness and potential reversals in the market. Traders who bought earlier in the day might have considered selling covered calls or tightening stop-loss orders to lock in gains. These strategies can help mitigate risk and ensure that profits are not eroded by sudden market downturns. Others might have looked for opportunities to short-sell overbought stocks or ETFs, anticipating a potential market pullback. Identifying overbought conditions can provide lucrative opportunities for those willing to take on the risk. Remember, the market can turn on a dime. Be prepared for anything. Volatility is a constant companion in trading, and being ready for sudden changes can make the difference between profit and loss. And most importantly, don't panic. Emotional decisions can lead to costly mistakes. Maintaining composure allows for clearer thinking and better decision-making. Stay calm, stick to your plan, and you'll come out ahead in the long run. Consistency and discipline are key to navigating the complexities of the financial markets successfully.